What if the next explosive growth for your portfolio is hiding in plain sight? As a credit card company, an oil and gas landlord, and a steel manufacturer. Sounds odd, but these overlooked giants could redefine your investment strategy. Each dominates its field in unexpected ways. One revolutionized banking, another profits from energy without drilling, and the third is building the future with green steel. This isn't your average stock-picking video. We're digging into the real stories and innovations behind these must-buy companies. Get comfortable, grab a notebook, and don't miss a detail. These insights could be game-changing. Smash that like, subscribe, and let's dive in. First up, let's talk about Capital One Financial, ticker symbol COF. You've probably seen their commercials, heard their catchy slogan, and maybe even have one of their cards in your wallet right now. But there's a lot more to this company than meets the eye. Sure, Capital One is a household name in credit cards, but that's just the tip of the iceberg. Their reach goes far beyond plastic in your pocket. They're a financial powerhouse with their hands in everything from consumer banking to cutting-edge technology. In fact, Capital One is often described as a tech company that just happens to be a bank. Their offices are filled with engineers, data scientists, and product designers, all working to build the next generation of financial tools. They've invested heavily in technology, making them one of the most forward-thinking players in the industry. Capital One was a pioneer in using data analytics to personalize financial products, long before it became the industry standard. Every swipe, every payment, every transaction is a data point, and Capital One has spent decades building a treasure trove of consumer insights. This lets them manage risk with surgical precision, spot trends before competitors, and roll out new products at lightning speed. Their data-driven approach is a huge competitive advantage, allowing them to innovate faster and smarter than traditional banks stuck in the past. They were also one of the first major banks to fully embrace cloud computing, moving their infrastructure to the cloud years ahead of the curve. This shift made them more agile, more efficient, and able to scale new services quickly. It's a move that's paid off, giving them the flexibility to adapt to changing customer needs and market conditions. But Capital One isn't just about credit cards and checking accounts. They're shaking up the auto loan market, using their data expertise to offer better rates and smarter lending decisions. Their commercial banking division is also growing fast, bringing the same tech-driven mindset to business clients and large-scale financing. And then, there's the potential game changer, the proposed acquisition of Discover Financial. If this deal goes through, Capital One would instantly gain its own payment network, putting it in the same league as Visa and MasterCard, but with a unique tech edge. This would open up new revenue streams, give them more control over transactions, and make them a true end-to-end financial platform. Even if the Discover deal doesn't happen, Capital One's digital banking platform is already one of the best in the business. Their mobile app consistently ranks at the top for user experience, security, and features. Customers can manage their money, track spending, and access innovative tools, all from their phones. At the helm is founder and CEO, Richard Fairbank, a visionary leader who's been with the company since day one. His long-term focus and willingness to invest in technology have set Capital One apart from the pack. Under his leadership, the company has consistently pushed boundaries and redefined what a bank can be. Financially, Capital One is rock solid. They've delivered steady revenue growth year after year, maintained high efficiency ratios, and rewarded shareholders with both dividends and share buybacks. Their balance sheet is strong, and they're well positioned to weather economic ups and downs. Despite all this, COF trades at a value price compared to the high-flying tech stocks. But don't let that fool you. This is a company that's innovating just as fast, if not faster, than many Silicon Valley darlings. For investors, that means you get real growth potential at a reasonable price. Capital One occupies a unique position in the financial world. They have the scale, brand recognition, and regulatory expertise of a big bank, but the agility and innovation of a fintech startup. It's a rare combination that lets them compete on multiple fronts, against both established giants and nimble newcomers. When interest rates are high, Capital One's lending business thrives. When the economy is booming, they capture more customers and expand their services. They have multiple levers to pull, giving them flexibility and resilience no matter what the market throws their way. The investment thesis is simple. Capital One is a best-in-class operator, using data and technology to outpace competitors. Their relentless focus on innovation keeps them ahead of the curve, and their ability to execute makes them a force to be reckoned with. If the Discover deal goes through, it would supercharge their growth and cement their status as a true financial technology leader. But even without it, Capital One is already a dominant player in a massive, essential industry that touches nearly every American household. The need to borrow, save, and spend isn't going away. Capital One's platform is built for the future, designed to meet the evolving needs of consumers and businesses alike. Whether it's digital payments, mobile banking, or new lending products, they're always a step ahead. This isn't some speculative moonshot. Capital One is a dominant, established company that's still finding new ways to grow. For investors, that means stability, but also the potential for explosive upside as they continue to innovate. Their hybrid model, combining the muscle of a big bank with the speed and creativity of a fintech, makes them both resilient and innovative. It's a blend that's hard to replicate and even harder to beat. That's why COF is our first must-buy, a tech-driven financial powerhouse with a long runway ahead. They're not just keeping up with the future of finance, they're helping to shape it. Don't let the financial label fool you. This is a technology and data story at its core. Capital One is leveraging artificial intelligence, machine learning, and advanced analytics to deliver smarter, faster, and more personalized financial solutions. Capital One is reinventing what a bank can be, blending digital innovation with real-world financial expertise. That's why it's at the very top of our list for investors looking for the next big thing in finance. If you want a stock that offers both stability and the potential for explosive growth, COF is a foundational pick. It's a company you can count on, but one that's also poised to surprise you with what comes next. The future of finance is digital, and Capital One is leading the charge, setting the pace for the entire industry and redefining what's possible for banks and their customers. Their relentless drive for innovation, their strategic vision, and their ability to execute on big ideas are what truly set them apart from the competition. Capital One Financial currently carries a market capitalization of $99.29 billion. The company reports earnings per share of $3.11 with a notably high price-to-earnings ratio of 71.79. In 2024, Capital One generated $53.94 billion in revenue, delivering $4.75 billion in net income. The stock trades around $223.27, which is about 28.8% below its estimated fair value of $287.58, suggesting potential upside for long-term investors. For any growth-oriented portfolio, this is a smart strategic play. Capital One is a company that's built to last, but also built to lead. So, when you think about Capital One, don't just ask what's in your wallet. Think about what could be in your future. This is a company that's redefining the possibilities of banking and technology. Ready for the next pick? Let's shift gears and move from the world of digital finance to the real-world energy sector. Stay tuned for what's next. Next, let's talk about a company that's quietly reshaping how investors can profit from the energy sector. Viper Energy, ticker symbol VNOM. If you're looking for a way to tap into energy sector growth, but want to sidestep the usual roller coaster of oil prices and operational risks, Viper Energy offers a unique and compelling solution. Unlike traditional oil companies, Viper doesn't drill, operate, or manage oil wells themselves. Instead, their business model is all about ownership. They hold mineral rights in the Permian Basin, which is the single most productive oil region in the United States, and arguably, the world. Think of Viper as the ultimate landlord in the oil patch. Oil companies do the hard work, drilling, extracting, and selling oil, while Viper simply collects royalty checks for allowing them to operate on their land. This means Viper avoids the massive capital expenditures, operational headaches, and environmental risks that come with drilling. Instead, they enjoy a steady, high-margin stream of income that's largely insulated from the day-to-day volatility of oil operations. Here's where it gets interesting. When oil prices rise, Viper's revenue surges, but their costs remain almost flat. That's the beauty of operating leverage. Profits can soar without a corresponding jump in expenses. Viper's growth engine has two powerful cylinders. First, they're constantly acquiring more mineral rights, expanding their footprint in the Permian, and increasing their royalty base. Second, as oil operators get more efficient and squeeze more oil out of each well, Viper's royalty income grows, without them having to lift a finger. Every new drilling technique, every technological leap in extraction, means more oil is produced from Viper's land, and every extra barrel means more royalties for Viper, all without any additional investment on their part. Their risk is spread across thousands of wells, operated by dozens of different companies. So even if a few wells underperform, the impact on Viper is minimal. This diversification makes their income stream remarkably resilient. The Permian Basin itself is a powerhouse, low cost, high output, and with decades of drilling potential left. It's the heart of American oil production, and Viper owns a slice of it. By owning mineral rights here, Viper ensures they're always part of the action, no matter which operator is drilling. One of the most attractive features for investors is Viper's dividend policy. They pay out high variable dividends that are directly tied to oil prices and production volumes. When times are good, shareholders see the rewards. This means you're not just getting growth potential, you're also getting real, tangible income quarter after quarter. Viper is majority owned by Diamondback Energy, a major player in the Permian. This relationship gives 𝗣𝗚r access to exclusive deals, strategic insights, and a steady pipeline of new mineral rights acquisitions. Despite the global push for renewables, the world's demand for oil and gas isn't going away anytime soon. For decades to come, oil will remain a critical part of the global energy mix. 𝗣𝗚r's business model is built for resilience, low costs, high margins, and the ability to weather downturns better than most traditional producers. If oil prices fall, 𝗣𝗚r can still stay profitable, while many drillers are forced to cut back or even shut down operations. Their business is elegantly simple. Own the land, collect the checks, and let others handle the heavy lifting and risk. For investors, this translates into a total return story. Capital appreciation as the value of their mineral rights grows, plus substantial dividends along the way. It's a smart, lower-risk way to get exposure to the energy sector, especially if you want to avoid the wild swings and operational risks of traditional oil stocks. 𝗣𝗚r's landlord model means they benefit from every innovation in the oil industry, every uptick in production, and every efficiency gain, without having to invest in new equipment or technology themselves. In many ways, 𝗣𝗚r is like a cash machine for shareholders, consistently sharing profits through generous dividends and capital growth. It may not be the flashiest business, but the economics are hard to beat. High margins, low risk, and built-in growth from both rising oil production and smart acquisitions. 𝗣𝗚r Energy holds a market cap of $4.99 billion with earnings per share at $4.44 and a low price-to-earnings ratio of 8.91. 𝗣𝗚r brought in $853.58 million in revenue for 2024 and reported $359.25 million in net income. Its current share price is $39.55, which stands roughly 26.5% below the fair value estimate of $50.02, positioning it as another stock with room to grow if market conditions align. For anyone seeking real asset-backed growth and income, Vietnam is a must-look. It's a rare combination of stability, upside, and income in a sector known for volatility. In a sector where headlines are often dominated by risk and uncertainty, 𝗣𝗚r stands out as a quiet, consistent winner, delivering for shareholders year after year. That's why 𝗣𝗚r Energy is our second explosive pick for long-term gains, a company that lets you profit from America's energy boom without the usual headaches. Ready to build a future-proof portfolio? Let's move on to our final company and see how you can round out your energy investments for the next decade and beyond. Our third pick, Steel Dynamics, ticker symbol STLD. Forget what you know about old dirty steel mills. This is a new era. The steel industry has undergone a remarkable transformation, and Steel Dynamics is at the forefront of this revolution. Steel Dynamics runs mini-mills using recycled scrap metal and electric arc furnaces. It's efficient, cost-effective, and far greener than traditional steelmaking. By leveraging advanced technology, they have managed to significantly reduce their carbon footprint, setting a new standard for the industry. Their process slashes energy use and emissions, making them a leader in sustainable steel. This commitment to sustainability not only benefits the environment, but also positions them favorably with increasingly eco-conscious consumers and investors. As one of North America's largest metal recyclers, they control the supply chain from scrapyard to finished product. This vertical integration ensures a steady supply of raw materials, which is crucial for maintaining production efficiency and cost control. This vertical integration means stable margins and resilience against raw material price swings. By managing the entire process from recycling to production, they can better navigate market fluctuations and maintain profitability. Growth comes from innovation and expansion into high-value products, like advanced steel for cars, construction, and infrastructure. These high-value products are essential for modern industries, ensuring that Steel Dynamics remains relevant and competitive. Their new Sinton, Texas mill is a game-changer state-of-the-art, designed for next-gen steel needed by automakers and infrastructure projects. This facility represents a significant investment in the future, equipped with the latest technology to produce high-quality steel efficiently. Positioned to benefit from onshoring infrastructure spending and the EV boom, STLD is at the heart of America's manufacturing revival. As the demand for domestically produced steel grows, Steel Dynamics is perfectly positioned to meet this need. Their management is known for operational excellence and a culture that rewards efficiency and innovation. This strong leadership ensures that the company remains agile and responsive to market changes. Financially, they generate strong free cash flow, reinvest wisely, pay growing dividends, and buy back stock. This financial discipline provides stability and confidence to investors, making it an attractive long-term investment. Their low-cost model lets them thrive even when steel prices drop, gaining market share as weaker competitors falter. This resilience is a testament to their efficient operations and strategic planning. Tariffs and trade policies now favor domestic producers, and STLD is a primary beneficiary. This favorable regulatory environment further strengthens their market position. The thesis: Steel Dynamics is a dynamic, innovative leader in a foundational industry. Their ability to adapt and innovate ensures they remain at the cutting edge of steel production. Their green, low-cost production gives them a durable edge. This commitment to sustainability not only reduces costs but also aligns with global trends towards greener manufacturing practices. Strategic investments like the Sinton Mill open new, high-margin markets. These investments are crucial for long-term growth and profitability. They're perfectly positioned for the biggest trends: infrastructure, onshoring, and the green transition. These trends represent significant growth opportunities for the company. Don't let the boring label fool you. STLD is building the backbone of the future. Their products are essential for modern infrastructure and technology, making them a critical player in the industry. Their ability to generate and return cash, plus invest for growth, is second to none. This financial strength ensures they can continue to innovate and expand. Steel Dynamics comes in with a market capitalization of $19.27 billion. The company has earnings per share of $6.87 and a price-to-earnings ratio of 18.78. For 2024, Steel Dynamics generated $17.54 billion in revenue, producing $1.54 billion in net income. With these solid fundamentals, the company maintains a steady profile in the steel sector, appealing to investors seeking both stability and industrial exposure. This is a bet on American industry, innovation, and efficiency. Steel Dynamics embodies the best of American manufacturing, combining tradition with cutting-edge technology. Steel Dynamics, the backbone of your portfolio and stronger than you think. Investing in STLD means investing in a company that is well-positioned for future growth and stability. That's our third and final must-buy growth stock. Steel Dynamics is not just a company, it's a cornerstone of the future of manufacturing. There you have it, 3 leaders, 3 powerful growth stories. Capital One, tech-driven finance; Viper Energy, the energy landlord; Steel Dynamics, sustainable manufacturing. These aren't random picks, they're strategic bets on long-term trends. Want to learn more? Check out my Value Stocks Investing Master Course. Link below. For exclusive tips and research, join our Stocks Galore Patreon. Which business model do you find most compelling for the next decade? Let me know in the comments. If you got value, like, share, and subscribe for more. Thanks for watching. See you in the next one.